Hi traders, Lance Ippolito here. I want to talk about trading options on small caps, specifically the Russell 2000 ETF, the IWM. Now the IWM is mostly made up at 23% of financials. So on the trading floor, when we hear of banks catching a bid, we often look to see what the IWM is doing. Banks up, IWM up. Banks down, IWM down. Usually small caps react first and lead the way for the market. So therefore, if the IWM ETF, the small cap ETF goes up, you'll start having S&P and Dow names follow it. Therefore, it's a really good indication of market direction. Now, small caps are going to be volatile. Using the ETF, we don't have to single out a single stock, which is great. But we also need to know that our range is going to be larger than, let's say, trading the SPY. So when I'm looking here at the IWM, it's right around 150.70 right now. If I think the IWM or banks rally, which makes up, again, a large portion of the small cap ETF, let's say I think it trades back up to 150, for example. So I'm going to say, all right, I think we could trade up to the 155 range from 150. I can look at a trading strategy to maximize my returns. So I'm going to go here, and you know what? I'm going to go to July options. So something that expires in 42 days. Now what I like to see here is what are the market makers who are pricing the options implying. So the 150 calls are 393, the 150 puts are 345. I want to look at a bullish strategy right around that 155 mark. Again, small caps, they're going to be volatile. So instead of just buying an outright call, I'm going to spread my trade out with a call spread, a bull call spread to be exact, and collect some premium on the upside if the IWM gets to 155. So therefore, I'm going to go ahead and buy the July 150 calls here for 384. I have 42 days for this trade to work, so I have time on my side. And I'm going to go ahead and sell. So I'm going to cap my upside, the July 155 calls here at 147. So therefore, I turn this trade in. Instead of paying $383 for the 150 call, so $383, I'm going to collect money selling that 155 call, and I'm only going to pay, let's say, $235 as a debit. So not a lot cheaper than that $383, right? So let's analyze how that trade looks like here. I have my max loss, which is, especially when we're trading small caps, we always want to know what our max loss is. And that is the debit that we pay for the bull call spread. So that will be $2.35 or $235 per one contract. Now let's say doomsday hits and small caps tank. Instead of owning the stock where I'm on the hook for the stock and I see it red every day and I don't know what to do and it ties up all the margin, by buying a bull call spread here, the max loss that I can have on this trade is the $2.35 or the $235, the price I'm paying for the spread. So let's say it goes to 145 next week. I can only lose $235. That's the beauty of it. Now let's say the trade works out to max profit and the IWM trades to 155 like I thought it would by July expiration. My gains are capped at $5, the width of the spread, so 155 minus 150, that's $5, minus the premium I am paying. So therefore, my max gain on the trade is $2.65 or $265. So I can more than double my money that I'm paying. That's fantastic. That's exactly what we want in trading. Here. Now what happens though if the IWM small cap ETF continues to go up and trades to, let's say, 165, well, my gains are capped here. That's fine. I'm very happy with the $265 gain on the ETF because that's where I thought the small cap ETF, the IWM, could print to. So usually, as a rule of thumb, when I'm trading higher volatility names like small caps, I like to spread out my trades because I don't have to risk as much money as buying an outright call option.